Welcome back to Rockstock Channel. It is Thursday, July 31st, and today we have Chris Robb from Chris Robb Consulting, as well as YJ Lee, the China Bull in a China shop, who we've had here on the program a number of times for what we expect will be a spirited lithium discussion. Viewers of this channel may remember that Chris and I had a bull versus bear debate at the Benchmark Lithium or Benchmark conference in Los Angeles last November. It was very spirited, entertaining. Some people commented that they thought they might have resulted in a fist fight. But no, wasn't the case. But Chris, who is here, we've never interviewed him directly, but I saw at the Fast Markets Conference, and the genesis of this was, hey, why don't we have another bull bear debate with the big bull YJ here? And I have Matt Fernley, our new partner here, who has never met Chris and YJ until about a day or two ago, and I wanted him to kind of intermediate here. He's somewhere in between YJ and Chris, but Chris refused to say that this should be a bull bear debate. This is a bull versus an old bear debate, because he's changed his tune a little bit, but we'll go into details as to what he's thinking. But Chris, for all of our viewers here, I do want to point you should go to his website, crobconsulting.com. Chris is a former lawyer and merchant banker, before he got into the commodity space. And then he spent 10 years as a trader and a shareholder at Glencore before it went IPO, did metals trading in the ferrous space, and involved very much in Russia with the steel investment in Meshel. He also worked as a partner at a $4 billion USA long-short equity hedge fund covering metals and mining and equity futures and some oil and natural gas refining. And the last 10 years he spent as a consultant to hedge funds, private equity clientele focused on long short public equities and futures trading. And he also does a bit of IR focused consulting. But if RK Equity, Rodney, Matt and I, are largely focused on institutional kind of long only. We're not much on the short side, as well as, for retail. YJ is on the buy side, but Chris, goes both ways, right? He's an advisor and has been very right in recommending, a lot of the hedge funds who are short lithium over the last 2 years have been taking advice, from Chris. And so he, it's good to have kind of like his perspective here. And if you're interested in his work, feel free. He's old school, not on X, so you got to follow him on his website, and feel free to reach out to him there. So, YJ, we interviewed you at the Fast Markets event. We'll flash up, that interview. That was just a couple of weeks ago. And you have a very outlier bullish, 4.6 million tons, 2030, lithium, demand forecast. And, and Chris, I introduced you to YJ, and you had a conversation there. I'll let Matt, kind of like take it from here after just this opening question. Chris, you've indicated you've changed some of your views, and said rather than a bull bear debate, you wanted to title this kind of like lithium bull, YJ versus equity long. So what do you mean by that, Chris?
Um, I sent something through last night. If Benji could pull it up, that's just a simple chart. That white line is the last cycle of lithium price in 2021. The blue line is Pilbara, the red line is Albemarle, and the purple line is Liontown. And what always happens with commodities and commodity equities is the equities always go up before the commodity price does. Uh, Equity investors very informed. They get bullish a little early, and the price starts rising before the commodity price does. And when I came out of the Fast Markets conference, what was pretty clear to me was that from an equity perspective, people were pretty bared up and just had given up, capitulated, weren't interested, and that's usually the best time to get long something in equity land. And then that view has been vindicated in the last month as most of the equities have gone up anywhere from 25 to 30%. I still think we're probably in the second or third inning, but you don't have to love the commodity price direction and think it's going back to $70,000 to make money in the equities, and that's really is my view. I'm certainly I don't know where YJ thinks the lithium price is going to top out. I'm probably below him, but we'll get into more of that. But that's just it's a pretty simple. Equities go up before the commodity price starts moving. That's what happened this time. The commodity prices moved a little bit. The equities moved a lot, and that's just kind of equity investing in commodity levered equities 101.
Okay, thanks, Howard. Yeah, so let's just sort of start with a quick introduction to where you both are coming from. YJ, obviously, as Howard referred to, you're a widely acknowledged bull on the lithium space. Can you just sort of give us a 2-minute summary on the crux of your argument, what your read is on the current rally, and just sort of summarize where you're coming from, and then we'll get into the questions in more detail.
All right, sure. All right. So over here at Arcane Capital, what I do is that I track both supply and demand very, very closely. So on the supply side, I track about 142 lithium mines around the world, and some of these are already producing. Some are coming into production by 2030, and I believe that these are all the possible supply that can come into the market within this decade, right? And I'm being fairly optimistic on the supply. I think that by 2030, we can go up to as much as 4 million tons LCE, but it requires the price to be high enough to incentivize most of these to come online. Then on the demand side, I think given where the lithium price has been in the last 2 years, it's been so low, and the scale of battery manufacturing has exploded so rapidly. That just means that batteries are cheap, cars are cheap, everything that relies on lithium is cheap, and therefore demand has to go up. I mean, this is basic economics, right? The demand curve, low price, higher quantity. But this is something that most analysts are not forecasting in their demand. In fact, they are slowing down demand these 2 years. I don't know why. It makes no sense to me when the price of everything is cheap and EVs go below ICE cars in price. There's a turning point here, and demand should grow even faster this period. So I think that demand will surprise on the upside. That's the crux of it in a nutshell. And I think that in my presentation with you guys earlier, I spoke about energy storage systems. I spoke about EVs. I spoke about electric trucks. I see these as the three main drivers of the lithium demand right now for the next 5 years.
Okay, and the current move, the one that's sort of ongoing at the moment, do you think that's a short-term technical puke, or do you think it's a medium to long-term fundamental shift, like a very hard bottom in the industry, and we go V-shaped recovery from here?
I hesitate to make short-term calls on prices. These are inevitably wrong. But I think we probably reached a bottom in the lithium price in the end of June, when spodumene was 600 for SC6, and carbonate was basically 8K, and that takes about I think half or 2/3 of the lithium producers into unprofitable territory, and that is not a sustainable place, right? If half the supply goes unprofitable, and if any part of that leaves even thinks about leaving the market, that balances it out right away. So this is not sustainable, and I think this is essentially the bottom. Whether the last few days in the GFAX matters or not, I don't know. I can't make any firm statements on that, but yeah, I think it starts coming back up from here.
Okay, that's great. So just moving on to Chris, fair to say that at times you've been a little bit more conservative. Can you summarize the argument as to why perhaps you're a little bit more conservative? And how do you think that you differ on your outlook for prices and equities compared to YJ?
I guess a couple things. One is YJ's, really did make kudos to him because he's the first guy I've seen that really spent a lot of time on the demand side, which is a harder nut to crack, to be very honest. And most people just avoid it. What I usually do is I just take 10 sell side models and average them because it's just the work is too hard. Um, so kudos to him, and every point he makes is correct. Um, I guess what I see different, why I don't think it's going. I always say commodities have prices have four drivers. One is incentive price, which we'll talk a bit about. One is C1 cost, all-in sustaining cost. One is tightness, looseness, and the last one is macro. And macro for lithium really doesn't exist because the futures market's not developed enough. So you end up with three things. And as YJ rightly pointed, it's $600 a ton spot. You mean $8,000 a ton lithium, because $600 a ton spot, you mean there's probably two, maybe three mines in the world that are cash flow positive. And so therefore, if that's the case, you can't feed spodumene to converters in China. Therefore, you can't produce a chunk of global supply. The brine guys at that price, $8,000, most of them are making a little money, some making some. There's probably a third or break even. And so on that part of the of price formation in commodities, you're clearly, as I just said, you're at the bottom. So what are you left with? You're left with two others. One is incentive price. We're going to talk about that a bit later. I think it's demonstrative that the incentive price is for spodumene, it's somewhere between $1,200 and $1,400. For carbonate, it's probably $14,000. And so this idea that we're going to go back to 70 to me, or 25, is just wrong. And what's different this time compared to last time, and by the way, the last thing is tightness, looseness. And the reason it went to 70 last time is when it gets to tightness, looseness on the upside, if you are someone who needs battery grade lithium for your cathode plant, and you have a delivery to make, you will pay any price. And that's always when commodities, when it gets tight, it goes asymptotic. And that's what happened last time. Now, why isn't that going to happen this time? Can Benji pull up my second? This is one of my favorite pieces of analysis I do. Yeah, that's it. That's the difference in pricing between onshore and offshore Chinese pricing and Asian pricing. And what you see is relentlessly that those prices converge. And why is that? Because Chinese producers qualified. They qualified to sell offshore, to sell to the Japanese, to sell to the Koreans, to sell globally. And so that offshore price is never going to go so high again like it did last time. That's number one. And number two is anything China can supply, when they can supply it, is just by nature deflationary. So you can see this compression as Chinese producers who are generally at the lower end of the cost curve can produce and compete. That's deflationary. So coming back to sort of Matt's question, I just don't think we're going to have the price spike we had last time, because the other thing is YJ would know, is in 2021, outside of China, you probably had, I don't know, 7 producers, 8 producers. We now have like 25. So, less concentrated market, more sellers. It's just deflationary. So, that's where I sort of come from, that I just don't think we're going to have the same price spike we had last time.
Okay, so let's go in and sort of dig into demand a little bit. In our call yesterday, Chris, you mentioned basically the two unknowns in the market here, and you sort of covered them again, which are demand and the Chinese raw material supply environment. And obviously, YJ, you're based in Singapore, pretty close to Chinese demand.
Matt, if I can interrupt, I don't think demand overall is pretty clear. It's just that, like the work YJ done is really getting in, like we can all get into the weeds on supply. He's done similar work on demand, and that's very much harder work to do. Um, that's all. I mean, it's just harder to get the level of I can get a lot of conviction on supply. I can't get that conviction on demand. So that's what I would say.
Well, I think by its very nature, because it's quite a subjective call. I mean, obviously, I've been a commodity strategist for 25 years, and it's like with an equity model, the demand is a very subjective call. You're making a lot of assumptions in there, whereas supply, as long as something doesn't go wrong with the mine, you've got a pretty good view as to
Yep.
what the supply is going to be going forward. So yeah, so obviously YJ, you're very close to China, which is the major area of demand, and obviously the major area of supply at the moment. And when we were talking this morning, you said that you speak Mandarin, so you're able to go in and read the Chinese reports in their natural language and speak to the Chinese producers on the ground. Like Rodney and me, you're pretty positive on BESS demand. Can you just sort of help explain sort of some of your demand assumptions to viewers? What's driving your BESS demand forecasts? What's driving your EV forecasts in terms of number of vehicles and battery size and things like that?
Okay, so for this, maybe we take a very macro view to start. What's driving renewable energy and why is BESS required, right? And so the first driver of this market is solar and wind, but now primarily solar because of how fast it's growing. Last year, the world installed about 600 gigawatts of solar. This year, maybe it's going to do a little bit more, 650, 700 maybe. And the bulk of that is in China. Okay, about more than half of it. In fact, China is putting up solar at a rate of maybe 350 gigawatts or even 400 a year for the next few years. So what's going on is that the more solar you put in, the lower your midday power prices go at the wholesale level. And for many markets, for many countries even, this price has gone negative. This means that you cannot put in any more solar without storage because you simply have to curtail that production. You have to ground that electricity right away. And solar is the cheapest and fastest electricity source, generation source that can be scaled today. Coal, gas, nuclear, nothing comes close. So with AI, with electric vehicles, with all the demands of electricity from the general electrification theme going on around the world, there's a huge need for more electricity, for more power, and only solar can meet this need quickly. And that means that every new solar project has to come online with at least 1 to 4 hours of storage. So if you take a 600 gigawatt market, right, that was last year's size, and you put 2 hours of storage in on average, that takes the market to at least 1.2 terawatt hours of storage, which basically consumes 3/4 of last year's entire battery production globally, right? So that's how large this market can be. And actually, we think that in 2030, solar goes as quickly goes to an installation base of about 1.5 terawatts, and then you put in an hour or two, and that consumes pretty much all the lithium in the world, right? So that is the addressable market. So from another point of view, we also did the calculations, and we discovered that less than 5% of all renewable energy being produced today is being stored. That's obviously too low. We need to probably raise this ratio to about 30-40% before we have enough power stored to do this massive load shifting from midday to evening peak. So that is the big picture that's driving the BESS story. Now,
Hey,
then you
YJ,
come down to the
YJ, can I ask you a quick question on that? Um,
yeah.
the best thing is well known. When I originally looked at this stuff back when I first started looking at it in 16 and 17, the killer app to me for lithium storage was actually manufacturing facilities who are subject to who are subject to daily differences in electricity tariffs. Aluminum smelters, for instance, fertilizer plants, any manufacturing facility that pays different electricity at different times of the day. Um, is that Does that matter when you look at your when you're doing your BESS analysis?
Yeah. So yes, the difference in tariffs does matter. But of course, these things are shifting very, very quickly. In different countries, different power tariffs or agreements are being put in place to address this new source of power generation, which is essentially storage and load shifting. So that's shifting. But I think this dovetails into what I was just about to say, the little picture, which is at the micro level, how companies are responding to this new technology and the opportunities. So one of the things I learned at the Fast Markets conference, here I credit the analyst from Fast Markets who specializes in the BESS stuff. He's a Chinese guy. So I spoke to him in Chinese, and I learned from him that what was happening in China is that commercial BESS is actually paying back in 1.2 years. And how are they doing this? These They are actually charging not just in the midday and discharging in the evening. They are charging also at midnight during the low power tariff power price, and then discharging into the morning peak. The margin here is smaller, but it essentially doubles the usage on the battery. It increases the yield of the battery by at least 50%, and that drives the payback period down to less than 2 years. And for large grid projects in China, the payback period similarly is about 5 years right now. So the economics are in place. Companies are responding to these economic incentives and putting in BESS as quickly as they can. I've not met a single BESS manufacturer, whether some are in China, some I've spoken to from Taiwan. I've not met a single BESS manufacturer who says that there is a shortage of demand for BESS amongst their customers.
I think the other thing that's really important in BESS is the change of the economics in BESS over the last couple of years. First of all, the change in battery technology. 2 or 3 years ago, the standard BESS product was a 2 megawatt hour product. Now in a 20-foot container, now it's a sort of 7 or 8 megawatt hour product in a 20-foot container. And that changes the economics massively, because your efficiency of the BESS products, your storage generation, the density, the lack of waste, etc. So the BESS product has changed enormously, and on top of that, that has an impact in the cost. 2 years ago, you were talking about what, $200 a kilowatt hour, $250 for BESS products. Now you're talking sub 100. So you now have solar and storage stacking up together as a cheaper option and a more efficient option than they were separately 4 or 5 years ago.
Yep. And Matt, one thing that you didn't mention was how much cycle life has improved for BESS over the years. LFP has gone to as much as 12,000 to 15,000 cycle life. Manufacturers are guaranteeing 8,000, 10,000 cycles right now. And if you look at it from a single charge discharge cycle every single day, if you take 12,000, you divide by 365 days, you've got what, 12 years, I think. You've got 31 years. And if you take 15,000 cycles divided by 365 days, you've got close to 40 years. So LFP batteries now last 30 to 40 years, and that's not, I think, being correctly factored into the LCOE models of a lot of analysts. I see some reports coming out that say that storage cost per kilowatt hour runs into the teens, and I'm like, no, not if you're dividing it over 30 years.
Yeah. Okay, cool. So we agree with one another on BESS, which is great. Let's move on to electric vehicles. And if you can just sort of, and if you can maybe split this between passenger vehicles and commercial vehicles, just talk a little bit about the numbers of vehicles that you're talking about, and also the other aspect, which is really important, which is the battery size.
Passenger vehicles. I think this year we sell about 21 million passenger EVs around the world. That's being driven a huge way by the 50% penetration rates we are seeing in China right now, which is the largest car market in the world. And they are exporting, they're not just consuming it internally, they're exporting these to many countries around the world, Europe, Africa, many, many large markets. And commercial vehicles, light commercial vehicles, probably under 1 million. And medium to heavy commercial vehicles, i.e., trucks, electric trucks, I think we probably do 300,000, just under 300,000 units this year. And I think I'm probably being a little bit too conservative on the truck numbers, because I just saw a number that came out of China recently. In the first 6 months of this year, the truck market, the heavy truck market in China was just over 500,000 units, and that's already a 10% year-on-year growth. But within this heavy truck market, 21% were electric. I was stunned. I did not expect 21% EV penetration among heavy trucks in China in the first 6 months of this year. That's really fast. So I think there's room to grow for that. Battery sizes, average pack sizes, I'm not too aggressive. I think pure BEVs, I'm running at 67 kilowatt hours, hybrids 29, commercial vehicles, light ones 85, and the medium and heavy trucks, I'm averaging about 215 kilowatt hours. That's probably on the low side, but I'm just being conservative there.
Okay, cool. Chris, any sort of comeback on those points?
No, I think this is what I think distinguishes YJ's work from what you see on most of the sell side. The level of detail and nuance and depth is great, and he makes very valid points. I mean, the most important one, which he started with, which was when things get cheaper, traditionally use more of it, and so um, number one. And number two is, I mean, the reason why lithium is different, and the reason we all got interested a long time ago is, other than iron ore in 2010 and 11, to have demand growth in double digits in commodity land is very unusual, and supply often has difficulty.
Certainly for such an extended period as well. It's just
and this is 15, 20, 18, pick your CAGR. YJ would say 30. I mean, the CAGR is very large, and at a certain point, supply does have a problem keeping up, and when that happens, price goes up, and we're certainly seeing the beginning of that after a period of downturn. And the other part with demand is and supply is when you get into law of big numbers, and law of big numbers says, it was very easy on the last cycle for the supply side to respond and over respond, right? Price signal got sent, over response, prices get cratered. This time for the supply side to over respond is going to be harder because we're dealing with much bigger numbers. So
Matt, if I could just interject, I just listened to the Albemarle call, and just to reinforce the demand numbers that they just put out, quite optimistic. Basically, global EV demand up 35% year on year, and with BEVs, plus 35%, and PHEVs 34%, but then ESS battery demand up 126%. With China up 80%, Europe up 150%, and North America up 160%. So BESS is really huge, and they've really reiterated their guidance, for anywhere between 2.5 and 3.3 million tons, in 2030. We'll flash these up here, but the first half numbers just coming in from the largest producer in the world, Albemarle, is just reinforcing, what YJ you've been saying on the demand side.
YJ, you would know this. Is Albemarle the biggest? I thought Ganfeng was the biggest.
Depends on what you are measuring. Albemarle is probably the biggest where it comes to conversion, because they've got so many converter plants in China. Ganfeng is huge as well, but don't forget, Albemarle now only has half of Greenbushes. So it depends on where you're measuring it, whether you're measuring it at the mine or whether you're measuring it at a converter. But yeah, I mean, Howard's right. Albemarle raised the point that demand is growing so quickly. But the funny thing is that they did not change their 2030 demand forecasts. They're still using that was it 2.8 to 3.3 million ton thing? And Howard, if you recall from my Raging Bull slides, there was one where I kind of teased Albemarle about their forecast errors. And I recall in 2017, they said that the 2025, was it? No, or market was what, 800 kilotons, something like that. They were off by 50%. In fact, the world got there
Yeah.
2 years early. So I think my point was that, and I think that this point still stands. I think their 2030 demand forecast, the world reaches there in 2028.
Look, I agree. They're certainly imperfect, and in fairness to them, they typically put out their annual guidance once a year, and that is in their first quarter. So it would be unusual for them to have adjusted it by this quarter. But I will mention that I did notice from, I guess, this year to last year, they didn't change their high end forecast of 3.3, but the mix was very different because they had a very small energy storage component last year, and now they have a very large energy storage component. And hat tip to Row Motion, who they reference, in this slide. We've had Iola Hughes. They've done kind of probably leading work, among the agencies out there, on the BESS market. So they're getting a lot of traction with Albemarle and many others in quoting their work.
Okay. So I mean, talking about supply, and Chris, maybe come back to you. Obviously, we've heard YJ's very positive views on demand. Do you think that the mining industry can keep this pace on the lithium side? I mean, some commentators that we heard think that demand is growing 10 to 15%. YJ's base case is 25%, and his bull case is 35%. So, how easy is it going to be for the mining industry to sort of grow at that sort of pace going forward?
I mean, it's pretty clear they can. The difference is, will they? This becomes an issue of a lot of the supply in the last 3 years has been greenfield, big single asset, like Liontown, big mine, Gulamina, big mine. The question is, are the majors going to, and coming when we get to incentive price, are they incentivized to add supply? Because they can add supply if they really want to. But the question is, until prices move some more, I don't see that happening. And if it doesn't happen quick enough, you're going to tighten the market and the prices are going to go up a lot. And this is the real question. Will people, at these prices, they clearly won't, brownfield growth, but classic case like Cachali Olaroz, Lithium Argentina, and Gangfeng. When are they gonna authorize the next stage? When are they gonna actually fund it and build it? At these prices, maybe not. And do you need a higher price to get them to do that? POSCO has said we're doing stage 2. They've said that. But is how fast is Rio going to be? Is Rincon, the original thing they bought, really going to get built? Are they going to authorize that? And so there's all this Albemarle classic case. Are prices high enough? Greenbushes expansions happening, but are they going to authorize other expansions? And so this is the real question: will they do it? And at these price levels, the answer is no, they won't. And
It's
if they
kind of a
do,
chicken and egg, though, isn't it? Because you need higher prices to incentivize more supply. But similarly, nobody wants to take a chance on incentivizing more or building more supply until prices go up. And then obviously once prices go up, you've got an 18-month, 2-year period when they've got to get built. So
and by the way,
that's
bullish, right? I mean, that's a bullish statement, and that's why it's not can they do it? They can. It's just will they do it? And then this gets into the opaque. I said there's two opaque things in the lithium business. One is demand, and the other one is the Chinese. I call it the Chinese molecule, the Chinese supply that comes from China, whether it be lepidolite, brine, or spodumene. What's the growth there? Are people building? How much does that matter? It matters a lot. And like this year, on a pure volume of tons year outside of China, will be down pretty materially from 2024 in terms of volumes, like not percentage, volumes.
The growth rate, yeah.
Just the tons the new tons that are coming out. Next year, should be higher than this year. But let's see. You have a couple projects coming outside of China, but not a lot. A lot of it's brownfielded. A lot of it's some of it's the Rio Tinto stuff. So it's just not. They can the industry keep up? They could, but I doubt that they will until the price still gets stronger. It's not strong enough right now.
Okay, which is a great time to sort of go into incentive prices. Obviously, you touched on it earlier. So can you define what an incentive price is for our listeners? And,
How I
when you think,
define an incentive price, and this is very important because in physical commodity markets, an incentive price is in some sense an academic concept. What it is it's a price that's going to get a CFO and a board of directors to authorize a project. They believe prices have to be at these levels to get something built. Or you should to build something and get an adequate return. When I say adequate return, what I mean by adequate return is, and this is, some people would say I'm too low, be a 20% pre-tax IRR, because that's what it's about. When you go to the board, they're going to say, "What's the IRR?" Okay, give me some sensitivities on IRR and commodity price. How does that move? What are the changes here? So if Benji can pull up the spreadsheet I sent, we can look at some IRRs on projects, and we can say, okay, like, to get this project built, what do you really need? And if you look at the top one is Bandara, which is a Brazil project. And what I've done is I've just taken year one through my life of mine, done the development capex, and then going forward, you have commodity price less all-in sustaining cost. Again, this is pre-tax. Now, it's not precise, because if it's precise, you'd have working capital movement, which you don't have, because I'm not going to run those numbers. But it's ballpark approximately right. And so, from Bandara to be built, you need a $996 a ton spodumene price to get a 20% IRR pre-tax for that project. You go to Ghana, Awoya in Ghana, much lower, because it's a lower capital intensity project. $665 will get you a 20% IRR. Now, again, these are based all on definitive feasibility studies. Now, is reality going to be that definitive feasibility study? Are they going to blow the capex out? Are they going to have scaling issues? So you could probably take all these incentive prices and add 5 or 10% just for those factors. Going down Moblin in Canada, great project that Siona has. Incentive price $1,175 to get a 20% IRR. Go down to Rose in Canada. In my opinion, not a great project, pretty low grade, but a lot of tons, $1,015 incentive price. Then go down to Spark Pack, which is Frontier, just came out. Really big number there, 1,530, to get that is. And an all-in sustaining cost, remember, what is all-in sustaining cost? Cash cost, C1 if there are some tantalum byproduct credits, sustaining capex, royalties, and most importantly, freight to China, because there's no spodumene conversion capacity right now outside of China. Okay, and some of it's being built. We'll talk about that later. And the last project is the Finnish restart. This is a restart of the core assets in Northern Territory in Australia. Again, very low incentive price there. Why? Because it's a restart, $815 to get that, to get a 20% IRR on that project. So then jumping in, I'm just going to do two in the brine space. One is Galan, evaporative brine. Evaporative brine, proven technology. I've got some bookshelves behind me. The book is a great technology. It's been with us a long time. It'll always be with us because it's a good technology. You don't need to innovate the book, and you don't need to innovate evaporative brine. When you're in a place where it doesn't rain a lot and you're 15 or 20 degrees latitude and it's sunny, it's windy, it's a technology that works, very low OPEX. But that's Galan's project, which will be built. One of the first part's being built. This is the second project. And when you look at again, all in sustaining costs, royalties, sustaining capital, you're looking at a price of about $14,000. Below that is Rhyolite Ridge. This is Rhyolite Ridge, and we'll talk a little about this. Is a sedimentary clay project with enormous boron credits. Borates is a great business. They're basically two producers in the world, very good business. Rio Tinto is one of them, the Turkish are the other. But again, this is a 96-year mine life, but the capex is ginormous. And to get a 20% IRR on this thing, you're going to need a $24,000 price. And Thacker Pass is the same, and you can go on and on and on. Some of the DLE projects are like this. And this gets into the whole question of what's the difference between incentive price and the price my project needs. My project needs this price to have a good IRR, so therefore I put fantasy land, prices in my feasibility study and say, well, that's what all the consensus says, because the consensus says, this is the price it's got to be to get these projects built. That's ass backwards. Okay, that's not how the world works. The world works, supply and demand sets a price. It doesn't set the price you need for your project to be built. And this is, a massive misconception. And that's why I said prices are not going back on a long-term basis. My opinion, above the $15,000. They may spike higher as you get a mismatch, but they're going to come down, and then you're going to end up with what are proper incentive prices. When we talk about DLE, I don't know, Howard looked at the Albemarle results. The most important results to me in lithium were Aramet. But Aramet is the first person to try to commercialize DLE outside of Qinghai Lake and outside of what Arcadium, previously FMC Livent, had done in Argentina, which is part of an evaporative brine process. To actually go full-scale DLE, we're using it. And if you saw, they dropped guidance enormously. They're losing a shit ton of money. Now, will they push through? Their balance sheet's not enormous. They're a real mining company. They're a real company. I believe they said they'll get it up and running, and I think they will. Through good effort, they'll get it running. It's a question of how much money does it make, and what's the cash cost? Because DLE is still, the jury is out. When you got a big balance sheet, you don't give a shit. Exxon doesn't give a shit. Equinor, Schlumberger, they're going into DLE, and they will make a good billion-dollar run at it, and you'll get some units out of that. Can it commercially scale and work? Question mark. We don't have an answer to that. What we've learned from Aramet is not so simple. And this is Argentina with decent, well-known brine grades, well-known contents, etc. So it's just, the jury's out. And by the way, that theoretically, if DLE is problematic, that's bullish. So
yeah, definitely. Okay, so YJ, coming back to you, as you said, you model 142, I think it is, lithium operations. Where do you sort of disagree with Chris in terms of the supply side of things?
Nothing
or don't
that
you
I
disagree?
would actively disagree with Chris. I think he's got a very good commercial sense on how things work in the real world, and he's absolutely right on that. DLE that Chris was just talking about, I totally agree. Aramet is the one to watch right now. If it works, then at least there's one pure DLE project out in the world. But all the DLE projects out there right now have a massive capex issue. It's just so expensive to build. Whether they actually come in at the lowest end, the first quartile of operating costs, we don't know, right? If it doesn't, then there's really no economic case for a high IRR for DLE, because you've got upfront high capex, and if you have high operating cost, the entire model is shot, right? Doesn't work.
And this and YJ is getting into a very important point. I model all these projects too. The difference between a project and a funded project is everything. Okay, being funded is what matters. Having a project, there's a zillion projects. Are they funded? That's what matters. And who's going to write a check against this stuff? And I can tell you, project finance is not going to write checks against DLE because they're not confident it works. The only reason Thacker Pass built was because the government gave them free money. That's the only reason. There's no other reason. No one's going to privately finance this stuff. No, it's not going to happen. Not going to happen.
Yep.
So even in the 142 mines that I track, I'm being quite optimistic on the supply here. I'm giving them the entire benefit of the doubt that they get funded, that prices are high enough. But of course, I know that this is the way my model works. I'm going to end up every single year pushing multiple of these projects back, a year or two, based on the funding situation. That's just how the real world situation is. And in the meantime, demand just keeps growing organically, while supply honestly cannot keep up. Now, the big wild card, of course, is Africa and China. there are some Chinese players that are making huge promises in some of their mines. I can name you a few that promise 50, 60, even over 100 kilotons LCE per year for each of these mines. There are a few that promise such sizes, but these remain promises for now.
Okay. My comeback on that is, if demand exceeds supply for an extended period and prices go high, what about demand destruction? Because obviously, if lithium prices rise substantially, that's going to push battery prices up. That's going to impact the economics of BESS, the economics of BEVs. What about demand destruction?
But even if lithium prices double, even if they treble, it does not mean that battery prices double or treble. No. Lithium is a small percentage of the bill of materials in a battery right now. And it's getting smaller because the effect is getting smaller because of the huge manufacturing scales. So what we have here is manufacturing economies of scale. The lithium price used to matter when the manufacturing processes were inefficient. Wastage was high, but now within those battery manufacturing gigafactories, whatever's wasted gets immediately recycled and put back into the start of their production chain. So there's a lot of wastage being saved. And what I can safely say is that manufacturing scale for batteries has become so large. You remember the when I think it was Elon Musk who first popularized the term gigafactory. Now battery factories come in 100 gigawatt scales, right? And I think before long, maybe in the next decade, we'll probably be talking about the first terawatt factory, right? Tera factory, maybe. So these manufacturing scales are
In
so
China.
large that yes, I mean, the first one would definitely be in China, no doubt about it, right? The manufacturing scales are so large that the process has become so efficient that costs have come down in such a big way. Yes, lithium costs will matter, but even if I think if we go back to what we think incentive pricing is at maybe 12 to 15,000 LC, it does not change materially battery prices.
I think I agree 100% with YJ, and this is a great point. Is that the lithium-ion battery industry is, where the car industry was in the 20s. Okay, I mean, it's just a new industry. It's just going to get more and more and more and more efficient. That's it.
Okay, so we touched on DLE. Obviously, another type of unconventional asset is the US Mexican sedimentary assets. So you think sort of more plain vanilla hard rock and conversion, and plain vanilla brine is going to be the way that the industry goes going forward.
Yeah, and the other thing is that recycling at a certain point is going to start mattering. Now it may be little, but every couple percent matters. And YJ can speak more to that since he's closer to China, but certainly there are recycled lithium units in China, and that will start. It won't be big, but it will start being part of the supply chain.
I mean, at the moment, it's more sort of faulty batteries, but obviously the number of end of life batteries will start to increase, over the next sort of 10 to 15 years or so.
Well, actually, Matt, this is one place where I might want to challenge you, because I don't think there's a medium-term story for recycling at all. So what happens is that, yes, the first couple of generations of batteries probably get recycled. Those in the cars that were produced up to maybe 2020, those have really short lifespans, cycle lives. But today, most of the cars being built today have cycle lives of over 10,000, right? LFPs, 12,000 maybe. NMCs, we are talking 8, so 8 to 10. So batteries now can outlast cars, right? If it's a 12,000 cycle battery, it can last 30 years. Cars, you generally scrap them after 10, 15 years, right? And I think there's a second life use for most of these batteries. You take them out from the cars, you stuff them into containers for essentially free, and then you have your a battery storage product. So I don't think there's much feedstock to go into recycling in the long run. And anyway, lithium prices are so cheap right now. There are no economics in recycling. There's no incentive for recycling.
Sorry, I just want to interject on this point. I was listening in my new Tesla to a podcast on Catalyst. There's a bunch of clean energy podcasts, but I didn't actually forward this to you yet, Matt, because I'm only halfway through it. But basically, the title is "Repurposing EV Batteries for Grid Storage." So we'll flash this up here if anyone wants to kind of like dig deeper into this topic. This is a very good podcast.
And the last thing I'd say on the supply side is I do think with the amount of effort and money going at DLE, eventually, I think some of it will get commercialized, and the technology will get better, and the scaling will get better, and there will be a sliver of supply that is DLE. I believe that will happen.
Well, Chris, on that point, you were mentioning like sediments don't get built without free money, but in the smack over to Matt's point, you have big balance sheet
Yeah,
oil
absolutely.
companies,
Agreed.
and
Agreed.
so do you think that Exxon, Equinor, Coke are is that from a U.S. perspective? If you look at sediment, smack over, then you have the Salton Sea, and Chris Wright, the energy sector secretary likes geothermal, and just before Biden left, they had a conditional commitment to energy source of 1.3 billion. If you look at those assets compared to, let's say, Kings Mountain at Albemarle, and Joel Jackson actually asked the question from BMO to Kent Masters, might there be an MP like Department of Defense deal to revive Kings Mountain? As you look at the U.S. landscape, Chris, what do you think of those four categories as to which might be the main supply source?
I think Kings Mountain is a slam dunk. That they will eventually build that. A smack over with the balance sheets involved, it will get financed and built. How efficient that capital usage is a different question. You'll never find out with Exxon, but with Standard, and you will find out. You rightly raise. I mean, in public equity land, the MP thing is a big deal, like a big deal. And I look at it from a shorting stocks. You can't short any of these story stocks anymore that have any tangential relationship to critical minerals in America, because the government could give them free money and you just get blown out. So MP is a big deal, and that may happen in other critical minerals. Absolutely.
Well, my point was, you're right. If the U.S. government's picking winners, you can't just say all sediment or all lithium stocks will rise. But I speculated, you were talking positively somewhat on Ioneer. They have $1 billion loan from the
Yes.
DOE, but might they rejigger that loan into a DOD equity deal, right? Like
When
MP.
you got the free money check, I probably would just take the check and raise the equity against the check, which is what they think they're doing, but maybe I'm wrong.
Well, if you look at what happened to the stock price of MP versus the stock price of Lithium Americas, being heavily indebted versus having the government as your equity partner, I
Sure.
would argue having the government as an equity partner is probably better.
Yes, I agree.
And
I agree.
what do you think about Salton Sea, given
The problem with Salton Sea is, well, first of all, I mean, word on the street to everybody you talk to in the industry is very difficult stuff to work with. Heat, uh, deleterious elements, but none of these companies are public, so it's all just kind of like, who do you talk to at the bar? And and so, like, that's not that's not an investable thesis, and that's not a basis for making this, for having conviction. Let's just put it that way. I don't know why Jay May can add his view.
No, I totally agree. I think for DLE, we need to be very, very careful. It's not a magic wand, and it's not a standard technology. So, DLE, as we all know, has to be customized to every single source. It's not something that you can take. If Aramet's technology succeeds, it doesn't mean that you can take it, drop it in the Salton Sea, and it'll work. It definitely will not work. So one of the main problems with DLE is that the brine that goes in has to be extremely clean, right? Because this whole DLE process depends on concentrating what's maybe 50 milligrams per liter into 10,000 milligrams per liter. It runs through this process a few hundred times. Therefore, any contaminants you have in this shall we call it the I'm thinking in Chinese, this doesn't work. The mother liquid, whatever you call it,
Yeah,
the
mother
starting
Pregnant
liquid.
liquid. Yeah.
has to be incredibly clean, right? Because any impurities get concentrated 200 times as well. So if you have any heavy metals, if you have any oil contaminants, natural gas, whatever nonsense stuff, it complicates this DLE process massively. It might contaminate your entire plant. So the pre-treatment cost for this DLE spikes up massively. So I think that only DLE projects with super clean sources in Argentina, in maybe Smackover, have a chance of working. I think the oil majors know this themselves. They know that, yeah, they may be really good at process plants, but they also know that oil shows from oil producing wells will not be helpful for DLE.
Just maybe if you could both give your thoughts. Obviously, SQM and the Atacama has been a major area of supply growth over the last sort of 4 or 5 years. Where do you think it goes from here? Obviously, DLE potentially could have a role to play there as well. So yeah, where do you see that going?
I look at, don't judge people on words, judge them on deeds. SQM just has the foot on the accelerator and they just want to grow volumes and they grow them every year. It's a great place to use evaporative brine and that'll continue. Now I try not to go past 2 years out in terms of trying to forecast supply just because I think it's too speculative. But the next couple of years, you're going to grow it at around 20, 25,000 tons a year for sure.
Okay.
Yeah,
and then what about Rio? Obviously, you've seen those 2 acquisitions in Chile. You've seen the Arcadium acquisition, which gives them a massive resource base and optionality in brine and hard rock, and they are a major, a big mining major, sort of coming into this space. So, where do you see Rio sort of going in the lithium space over the next sort of 3 to 5 years or so?
I mean, I think they're going to put the pedal to the metal and they're going to build this stuff. That's it. I mean, and people make this thing, wow, there's a new CEO and he may not like it. That's bullshit because listen, there's a board of directors that authorize that thing. That board of directors are still around. Okay. They don't go away. They're not going to say, oh, we just authorized it. Now we're unauthorized. No, they're going to go for it. They're going to put the pedal to the metal. Big mining company bureaucracy. Maybe it happens a bit slower, but if you can be slower than Paul Graves, then that's being really slow because that's a slow guy. So, I mean, I guess he's still running the lithium unit. So who knows? But I mean, they're certainly gonna finish Nemaska. They're gonna build Beckenor. We're gonna get our big chance to see North American conversion. Does it work? Can they get it to scale? Does it get scaled up? Sal de Vida is a great project. That's a good evaporative brine project that'll get built. And they're gonna grow those assets probably faster because they have a bigger balance sheet than Arcadium were. That's it.
Do you think they can
Well,
afford to pull the trigger now? Given that there's signs that lithium prices have bottomed, do you think Rio will start to pull the trigger now on expansions, or do you think they'll hold off for a little while?
I mean, I think when they bought it, they said we're accelerating it slightly because we have the money to do that, and they gave you a time frame. And I just I generally believe people unless they give me a reason not to believe them. They're a big mining company. They certainly know how to build.
But
stuff.
even if Rio pulls the trigger right now, it's a 2-year build time and then another 1 year to ramp it up.
Yeah,
It's a 2028 story.
That's right.
It doesn't affect the near-term lithium supply.
Yeah, I mean,
But I'm just thinking if they pull the trigger now, they'll be the only people.
No, it does impact near-term lithium supply in the sense that they will get Nemaska going faster, they'll get Sal de Vida going faster, but I mean, you're going to get a little bit of that in 26. You're going to get some in 27, and YJ's right. Most of it's going to come later, but it's going to come.
Could I, Matt? I just want to ask this question as we're talking. You think Beckencore gets built, and you talked about in some way challenged, unconventional, assets. But on your thoughts on hard rock conversion ex China, because WA has had a very difficult time with that, but POSCO PLS looks to be good. Tesla Texas, to be seen.
I mean,
Rio Beckencore, you mentioned. What are your thoughts on that?
I mean, can Benji pull up a slide I sent? Yeah, that's that the bar graph on the left is from a Gongfeng release maybe 2 years ago. On the right, that's the refining capital intensity of some Canadian, U.S., and in a German project. Listen, this is just something that the non-China does not have comparative advantage. We have disadvantage, and you can build it. It's just a waste of money. And Tesla built one, and they're having teething problems. They used a new technology which had never been used in the industry before, which is a big danger sign. Keliber in Finland intends to use the same thing, and it's very expensive. And I don't see Albemarle, when prices were crazy, said we'll do it in South Carolina. Now they said no, we won't do it, and this is going to be very difficult to have happen. And this is the classic one where free government money really helps because you're so much more capital intensive.
And on that point, Chris, if you said Kings Mountain is a slam dunk, I've speculated that if the DoD were to come into Kings Mountain, then Albemarle could revive their South Carolina megaplex. And if the government is willing to give more than 2 times or nearly 2 times the NdPr price than the current price, if they gave a price floor to Albemarle at $20,000 or $25,000 a ton for hydroxide, right? That's about twice the price. Then they might build it.
The problem with that approach, Howard, is it skips one thing, which frustrates me that people don't bang the table more on this. Is that it's very simple to take carbonate from Chile, bring it to America, add hydrated lime, and make lithium hydroxide. You don't need to convert spodumene into hydroxide. That's what Arcadium does now. That's what Albemarle does now. Why do you need to build a spodumene converter? You don't, actually. If you really want the chemical in America, you don't have to do this. And so,
okay, but in MP's case, they wanted the raw material to come from America and the conversion to come from America.
This is the issue: is MP arguably was probably a special situation, and we in the equity analyst world, as YJ knows, is you now have to get in the brain of the Trump administration as part of your equity analysis for certain things and try to figure out what they're doing. But NP was a unique situation where there was a big time negotiation was happening, and somebody thought they had some leverage, and they realized, oh, these rare earth things shut all our manufacturing facilities down, so therefore we better sort it out right now, so we don't have this problem again. Because I don't like going when I think I have leverage and I don't have it. So NP is a bit of a unique animal. I don't think that's lithium, in my opinion. And YJ, what do you think about what I just on conversion outside Chinese spodumene conversion construction? I'm very interested in your opinion.
Well, you're right. I mean, non-Chinese really cannot compete in upfront cost and the operating conversion cost. But what I'm seeing right now is pretty stubborn Western world that wants to push ahead with this decoupling, and I can understand it from a strategic, supply chain safety point of view. So if they want to push ahead with it for these reasons, then what we are doing is simply building a 2-track world, one where China and its customers get cheaper cars, cheaper everything electric, everything battery, and the Western world gets more expensive cars, more expensive everything.
YJ, can I ask you a couple of just data questions? When you in China for spodumene conversion, what do you use as the conversion cost? I use 22,000 RMB. What do you use per ton?
Yeah, close enough. 20,000. Yeah.
And in conversion factor from 6% spodumene to a ton of hydroxide, 7.2. What do you use? How many tons of spodumene?
Hydroxide.
Yeah, spodumene. How many tons of spodumene per 1 ton of hydroxide per converter?
I usually think in terms of carbonate. I usually think 8.5. But if you are thinking hydroxide, I think it's the same. Yeah.
Okay. Thanks.
I
Okay,
mean,
Matt, are
I
we?
think one of the
Are we?
things that I would say on China is that the Western world has this sort of issue with China in terms of the fact that it thinks that China is behind it in processing. And maybe that was fair 10 years ago, but it ain't fair these days. And certainly in the last 5 years since the pandemic, China has jumped a long way ahead of the West in terms of the quality of its processing facilities, capacity, strategy. Chinese industries are very, very integrated. One industry's waste product is another industry's raw material. I think that the West is perhaps not realistic about whether it can compete with China in some of these processing areas.
Okay. We're an hour and 12 minutes into this, so we should wrap up in the next 10 minutes. Let's kind of talk about pricing, and I guess Chris and YJ, if you want to stick your neck out. Chris, you seem to have a more subdued, price peak. But if you were to look, and I know you don't like to forecast, further out, but if you could, on a 6, 12, 36-month, outlook, how do you think lithium price evolves?
I guess I'll go first. Let's stick my neck out. Um, I think that uh, it will be it'll be one of two things. It's going to be a kind of slow grind higher for a couple years, or YJ is going to be really right on the demand thing, and then you're going to get a spike, and it's going to go bang, bang, bang. And when it goes bang, 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 spodumene will probably go 2,000. If he's right on demand, and you get that, and you get a demand spike, it'll go bang like that. It'll go up fast. But I think it's just going to slow and steady. It's going to creep higher. Chemical, same thing. And mainly that's because I think 25, as I said, in a volume versus 24 is pretty materially lower. But 26 is going to be materially higher than 25. But the other part is, do we get some curtailments? Do you have some of the stuff get pushed out? We'll see. Not exactly clear. And one part of the big issue here is that what's the level of growth in China on supply, on the molecule on the supply side? That's very hard for me to get a handle on, but YJ may have a better sense of that. But clearly he's right on the demand side. Demand's going gangbusters, and supply is the other thing. I'd be curious YJ's opinion about when you look at the market. One of the things I've noticed is, um, Guangzhou inventories are about 10,000 tons now. They were as high as 50. Now, when you look at base metals, exchange inventories matter, because an exchange inventory is money. When you have a warrant, it's money. And so, when they go down, it means that either people are stockpiling them outside the exchange, or you're actually seeing that is a source of supply for people who have a problem finding units. But I don't know. I talked about a bunch of things there, Howard. Apologies.
That's all right.
Yeah, but lithium is a pretty young market, right? I'm not sure if the players in the market are actually behaving the same way they are in other base metals, where the exchange acts as a kind of a buffer inventory stock. So many of these contracts are bilateral. So they've got offtakes, they deliver to these offtakes, 1-to-1. So there's no exchange involved for most of these guys. So yeah, I mean the whole Guangzhou futures market for lithium is very new, and right now that is what's driving most of the lithium prices. But I wouldn't use that immediately as a data point to say that this is the turning point. But I think if demand really turns out to be stronger than what people think, and I think maybe next year, well, we are already in August tomorrow. I think early next year we probably see this this market coming back into some kind of balance and prices going back to some normal level. I hesitate to make any price forecasts. I've never done so before, and I don't think I will start today. But I think I just want to point out that lithium has been the best and the worst performing metal in I think 4 out of the last 10 years. So there's a good chance that it could be the best performing metal after a few years of massive underperformance.
YJ, I used exactly that terminology kind of last year, and here we are. I was hoping this year would be one of the best performing, and so far it's looking to be among the worst performing again. So we shall see. Okay, so but you think early 2026 we could see a turn, but you're unwilling to predict, price. And 2000 spot, Chris, that's like a peak. What's that equivalent to?
I
And
think
that's, I
that's
guess,
probably
high teens in the chemical price.
probably
Okay,
if YJ's right on the strength of the demand, yes, that could happen. Otherwise, I would say it's sort of a slow and steady grind higher.
okay, but even those levels aren't incentive price enough to, for some of those projects that you mentioned earlier,
Correct.
to get into production.
Correct. I mean, that's why they're not going to be built unless somebody gives them free
Okay.
money.
Okay, so YJ, are you that conservative in your upside scenario without forecasting a specific price? Is that what you're thinking, or are you thinking higher?
No, I think I'm bullish in volume, not necessarily in price. I hesitate to make any sort of predictions where metal prices are concerned.
Okay, Matt, do you have a view?
I think my view is closer to Chris. I agree with. I don't disagree with YJ on demand. I do slightly disagree with where we are on the inventory situation at the moment. And when you get a fundamental price recovery, you generally see inventories clear out for 3 or 4 months, maybe 6 or 8 months before that happens. And I don't think we're seeing enough of an inventory clear out at the moment to be a fundamental supply demand imbalance price recovery. So for me,
But
I
Matt,
like to see inventories clear.
I got a
Go on.
question. How do you track inventories? I mean, like, how can you know what inventories are?
Yeah, so a number of the Chinese data providers
But
provide
how do they know?
inventory series.
But how do
Sorry?
they know? How do they know?
They call around. Basically, that's how everybody does business in China. They call
I know.
around the
When I was at
companies.
Glencore, they used to call around about the cobalt price and ask us what we thought about the cobalt price. We told them whatever we thought was good for our book. So this is like, this
I
is
mean,
just
I look with Chinese data. I've been it's 25 years into my career now. I've been using Chinese data for 25 years. Everybody's always said what you said, but I've still been able to call cycles all right on it. So
YJ, you got an opinion on Chinese data? I don't know. Maybe I'm wrong.
No, I think I don't think Chinese lie about the data that much. Actually, a lot of Westerners think that all Chinese data is fake, but actually I think most of it is actually not all that bad.
All right.
Yeah, it's very difficult. It's very difficult in this market to say like, oh, someone said this out of China, and then all the West says, oh, you can't believe anything you read in China. So it's like, there's all these unknowns. Look,
Matt,
we got five.
Matt, who do you use as your data? It says Shanghai Metal Market, Asian Metal. What do you look at?
I've used a number of them one time or another. I used ICC Sino, Asian Metals, SMM. At the moment, I'm using SMM.
Okay. Thanks.
Okay, last 5 minutes, just last cycle or even this or last up cycle, we saw a lot of development assets kind of getting bought up. Then at the bottom of the cycle, Rio bought Arcadium. Which stocks, or lithium assets do you think are likely to be acquired, in the next upcycle? Because Chris, you're saying, you could be equity long, and maybe hopefully, the equity guys are seeing higher lithium prices, from here, and that could lift more boats, in the lithium space. So price matters, but also M&A activity matters from an investment, point of view. So I'm just curious, what type of assets And might we see other players join Rio, like big oil? Hancock was in there, or maybe some other big mining, or big chemical may come into the space. So what are your thoughts on that?
I think that it's unlikely that non mining companies will come into the space. Number one, I think it's also unlikely chemical companies will come in, because the chemical companies found out the hard way was in lithium they get mining multiples, which they don't like. They want chemical multiples. And then in the mining side, BHP is a clear no. Glencore is also. I mean, last time I saw Gary Nagel, he said it's a no. And so then you're stuck with who's left. Anglo's left. Vale's left. And question mark, would they want to get into lithium? You're at the bottom of the cycle. Now's the time. And then if you're not going to do that, then you're left with, lithium companies or Chinese acquirers picking off good development assets. And certainly in before the last boom, Zijin mining in 3Q, Costco bought something, and you saw some of them get in at the bottom into development assets. I think M&A is more likely to happen on the development equity side than a producer. And just look what are the best, and then find out what do you think the best development equities are, and those are the ones that were likely to be acquired.
Okay, and you don't think big oil comes in?
No, I mean big oil comes in where in the smack over it made sense because of oil, because all the brine is in historically oil or sedimentary oil like deposits. I don't think they're going to decide to go buy Patriot. Let's put it that way.
Oh, but why wouldn't they buy Albemarle?
They wouldn't buy Albemarle because, maybe it's a valid point, Howard. The guys who have petrochem businesses, maybe they would. I don't know. I just don't.
They got the whatever Magnolia, and if you want expertise, I mean, Rio bought expertise as well as assets.
Well, I don't know how much you ever spend any time with Exxon people. They don't think they need any help from anybody on expertise. They know what they're doing.
That's true.
Go talk to one of them.
Well, they believe they know what they're doing, but it's inorganic chemistry, not organic chemistry like oil is. But anyhow, okay, YJ, what do you think in terms of who might come in and what are the best? Who might be acquired? What types of assets?
In perfect intro to YJ, the people who will definitely be acquiring are Chinese companies. Those are the acquirers, is a general statement. So
where they're allowed to.
Yeah, until they run into the government roadblock that says no Chinese buyers allowed.
Okay, so YJ, where do you think? Because a lot of the Chinese buyers, if they're Chinese, which ones? Because they're not. Well, Ganfeng is no longer, making too many acquisitions lately. But anyway, where do you think? I agree. You're probably right, and YJ, you'd probably agree that Chinese will buy good development assets like they always have. But YJ, do you have a view on any other players and what types of assets from an equity point of view? Where should you be buying if you thought that an asset might get taken out?
Well, there's a lot of questions, but to who's buying, I don't think necessarily Rio might buy. For example, Rio could buy more, or even any other mining company could come into this space. There are not many metals that are enjoying a long-term, 15-20% growth rate into the next few decades. So this is a source of growth. All companies might look at this as a replacement to a declining oil industry, which actually, well, I think peak oil is already past. So they might be looking as well, and they have the money. But I tend to think of investments not from who's going to get bought out in the next 6 to 12 months kind of thing. I just like to invest in long-term performers, companies with good growth, low capex, and preferably in the bottom half of the cost curve. I don't like to speculate on technologies that give you an option size return if they work. So I don't like to play DLEs. So I think at the bottom of this cycle, my well, I will not make any stock recommendations, but I will say to potential investors, look for quality companies. Everything is cheap right now. We are at the bottom of the cycle. There's no need to overpay. Well, nothing's expensive, but there's no need to take on too much risk to chase a highly speculative outcome.
That's where I disagree with YJ. Everything is not cheap. If you use earning multiples, things are actually expensive, and depending on the lithium price you use. For Pilbara, you get like, traditional mining stocks trade 4 times when prices are high, 6 times when prices are low, EV/EBITDA next year or 2 years out. When you look at someone like Pilbara, you need to get that multiple to work where the price is today. You need a $1,300 spodumene price in a couple of years. Price today is $780, right? So they're not cheap.
Yeah, Chris, but here we are talking about quality. We're at the bottom of the cycle. You are buying into, for example, a Pilbara with one of the lowest production costs in the industry,
Yes.
and still making some money at this level.
Yes.
So when prices go back to what you think is the long-term incentive price, then calculate your multiples based on that. Because I think we go back there in just a couple of years, or maybe even next year. It doesn't take that long.
Well, I mean, the thing I would say to YJ and to the audience is that, the commodity equity 101 investing. If the price is going up, the equity goes up. People don't give a shit about the multiple. Prices go up, people buy the equities. It's pretty simple. So if you believe prices are going up, now is probably a good time to get long. That's why my clients are long.
Yep.
Okay.
I mean, fundamentally, we agree on that. So you're more of a momentum player. I'm more of a contrarian, deep value bottom fisher. So, but both, at least we agree that prices are going up.
Well, no, we would agree is the best time to buy commodity equities is when prices are at the bottom, right? I mean, they were at the bottom.
Well, that was the end of June.
Yeah,
we are 1 month past that now.
Yeah, we're in the second inning.
Okay.
We still have 7 innings to go, right?
Okay, so on that score, Chris sees a slow and steady rise in the price, if I want to characterize what you said earlier, and YJ is calling for a early 2026, return to normal without fixing a price. So both of you think the prices are going to continue going up into 2026, and valuations, as you described, Chris, some things may be expensive on an EV to EBITDA multiple, but the market momentum are like, if the price goes up, they think it's going to continue going up. And you just said Pilbara, may be expensive or pricing in $1,200 or $1,300, but if it goes to 2,000, then even Pilbara is cheap.
And this is not how YJ invests, but if you really believe lithium prices are going higher, you want to buy the crappy companies. You don't want to buy the good companies, because the crappy companies are going to go up more. Right? I mean, honestly, that's just a fact. I mean, that's also commodity 101 investing, because the crappy companies have higher costs, and so when prices go up, their margins expand as a percentage more.
Okay, and that's perhaps the most optimistic thought, after an hour and a half of talking, is that lithium prices are going up, and even that rising tide should lift all boats, high quality and low quality. Okay, with that, we have a call actually that I'm 3 minutes late to. So we're going to end it here, guys. Very nice talking to you. Thank you, YJ, for putting on the Rockstock channel hat. And we'll speak with you soon.
Take care, guys. Cheers.